good morning. You're with us here on a fresh new edition of Bazaar Morning Call. End of the week, Friday. And, it's going to be an interesting one in terms of how we wrap up this big week. It was the big week in which there was the budget. Markets had a bit of a swoon, a couple of hours, and then we just sort of right back moved higher. We're coming to you from the CNBC-TV18 News Online studios. I'm Prashant, with me my colleague Sonia and Nigel. Guys, hi, morning.
Hi, good morning. It was a very resilient week as well, right? Given everything that we saw, I think the market would take the level of 24,400 with both hands. But so many cues to track. There's ICICI Bank's numbers tomorrow as well, so we have our hands full.
Well, that's right. In post-market hours as well, we got the PCI data coming in from in the United States as well. But the most important cue, I think, is it's the weekend finally, right? I mean, it's been quite a tiresome week.
Yeah.
You know, it was also yesterday, there was a discussion going on. It's the 26th of July.
Yeah.
The big sort of,
downpour that we had.
Downpour which happened back in the day, I think 2005. But it's calmer.
I mean, downpour
it's
is actually a mild way to put it.
No, it was
what happened in
I was not here. I was
2005.
in Delhi at that point. But I mean, I was sort of listening to what happened. I mean, I think it comes up every year, people who've kind of gone through that. But it's calmer. It's not a downpour anymore, at least right now. And I think the schools are open, offices are open. There was some speculation that maybe the BMC is going to send an advisory out. But late last night they came out and said, well, there's nothing of that sort, and normal kind of rain situation in Mumbai. More on that later. But let's just quickly tell you the market action, right? I mean, where we left off. So it's hit after hit. It's the election, it's the budget, it's a sharp US fall. But guess what? The market's just sort of treating all of this as water off a duck's back. Nothing at all. I mean, resilient or whatever you want to call it, but that's where we are at. So 4% fall day before yesterday in the NASDAQ, and we ended absolutely flat. You looked at yesterday's close, you wouldn't realize that the US had done what it had. And by the way, it's not as if Asia yesterday was resilient or Europe was higher, nothing. It was just the market here in India which looked up. So overnight, I mean, it's a bit of a reversal which we're seeing. Once again, I mean, we saw this day before, the week before, where tech started to underperform and small cap started to run higher. And then, that reversed once again, but it's back again. So large cap mega tech, because of earnings largely, is underperforming. And the small cap, which is looked at through the Russell 2000 index, that is starting to perform once again. So, I call this the continued unwinding of consensus trades. There are two broad consensus trades. One is the fact that mega caps will continue to do well to the exclusion of everything else. I mean, we put these numbers out earlier as well through the course of the year. How much of the gains in 2024 are driven by just the top 5 or top 7 stocks, the magnificent 7 stocks? So, and maybe that is still true. There is still more gains to come. But lately, we are starting to see unwinding of this trade. I mean, the broader market, the small caps in the US are starting to do better, and the large cap technology stocks are starting to underperform. Names like Nvidia, Tesla, Microsoft will report next week, Meta will report next week, Amazon will report next week. But what we've seen so far isn't exactly all that great in terms of earnings. The other big consensus trade has been the yen, right? I mean, you basically borrow wherever the currency is cheap and use that to buy whatever else is high yielding. It could be other currencies like the Mexican peso or whatever, or it could be other assets as well. And where money is cheap is Japan. But what we've seen is the yen has gone from 165 to 100. I mean, I'm not talking about last night's action, but lately it's gone from 165 to 155. And what that is doing is it's basically sort of forcing stops to be hit. It's a big talking point globally. Is it showing up in equities around the world as well? I mean, it's hard to say on a day-to-day basis, but something to watch out for because the move has been so large. In terms of data last night, second quarter GDP saw a big beat. Consumer durables, sort of goods orders, they saw a big drop. So it's kind of mixed, not really a clear picture. Yields were flat, dollar index was flat, and of course, the core PCE data later today will be something which the markets will watch out for. Now, just to sort of circle back to the levels here, Nifty, resilience, right? I mean, it broke the 20-day moving average again, but again it closed back above it. Supports for the Nifty are at 23,988. That's a daily Bollinger Band on the downside. And then the 40-day exponential comes into focus, which is 23,884. On the way up, Nifty needs to close above the high of 24,854. So that's essentially the Nifty levels, both on the downside and on the upside, of course, is the previous high. Bank Nifty closed below the 40-day exponential moving average yesterday. There is a small intermarket divergence. The Nifty did not break the prior day low. The Bank Nifty did. So we'll have to watch this. It's already retraced 38.2% of the entire rise. The rise from the lows of 4th of June to the recent high, that stands at 55.77. We almost hit it yesterday, but not quite. Next sort of big support for the Nifty Bank is the 50% retracement, which is 49,718. I just want to make a quick mention of the positioning in index futures. Guess what? Clients were, big time short. They are now long, small long, but the positioning is flipped. And FII longs have fallen to very small 60,000, 62,000 contracts or so. So it's interesting. GIFT Nifty will come up on your screen. I would say there is not enough comfort out there to really go out there, at least on an index level, and be long in a sort of really aggressive kind of a way. So if you're trading the index, I think I would still say caution at the margin is warranted. You get big swoons, those get bought. But if you start higher, where do you go? In that sense, I think it's a bit more sort of confusing at this stage. Stock-specific action, I think, is the name of the game, which we will get to as we go along. Sonia.
Absolutely. And, it has been a very resilient market, right? That's the only way to put it. Given everything that's been thrown at this market, it has held on to this 24,400 mark, which I think will be taken with both hands. But the important part is that FIIs have started selling as well. So if you look at what's happened in the last 3 days, there's been relentless selling from FIIs. Yesterday, too, FIIs sold about 2,600 crores in the cash markets in a single trading session. And put together now, if you look at the last 3 days, right, there's been about almost 10,000 crores of selling from FIIs in 3 trading sessions. So just keep that in mind. But simultaneously, there's buying from DIIs as well. So yesterday, there was buying of 2,500 crores. In the preceding day, it was almost 3,200 crores. So it sort of evens out in that sense. But don't lose sight of the fact that FIIs are selling big time. Now, a lot of stocks in focus. IT stocks will continue to be in focus this morning. Tech Mahindra came out with a muted set of numbers, actually, so there was nothing much to write home about over there. No negative or positive surprise. MGL would be in focus today because the margins and the profits were better than what the street was estimating. After the strong set of numbers that we got from a couple of these private sector banks early on in the earnings season, tomorrow ICICI Bank will definitely be in focus, so keep that on your radar. Dr. Reddy's will also be reporting their earnings tomorrow, so lots to talk about in terms of individual stocks. But for now, the GIFT Nifty is suggesting a modest positive opening this morning, up almost about 35 odd points. But Nigel, over to you. What are you tracking this morning?
Well, this morning, the Nifty Bank is going to be vital because we have the draft LCR norms that have come out from the RBI, and that could weigh on the banking names. But the banks need to perform from here on if this market needs to trend higher. Resilient, yes, but the Nifty Bank has been underperforming. And that's been a problem pocket even in the past series. That's the July series. But we kickstart a new series, which is the August series, and plenty to look forward to. You've got earnings, you've got the Fed policy meet as well that we'll be looking forward to, the RBI meeting as well, and also we'll have the quarter one, GDP print. So lots to look forward to in the August series. And by the way, the August series is a relatively longer one, which impacts the cost of carry because there are close to 35 calendar days in the August series, which is much more than what we normally see. And at the start of the series, if you look at it, the market-wide open interest, well, it's at record levels yet again. Last month, it was at record levels. Now it's even higher than that. The rollovers are more or less in line, but the market, while on the whole, well, that's at record levels as well. Moving to the positioning on index futures then. The FIs, well, if you look at it, they have cut their long positions. They started the July series aggressively net long. Now they're net long, yes, but it's relatively lower. The clients, by the way, they have covered those short positions and now they're mildly net long on index futures. But what's common in their positioning, the FI as well as the clients, is on stock futures. Both of them are net long on stock futures. Whether you look at the FI number and the client number as well, even at the start of the July series, we had made this point that they continue to remain net long. By the way, this is the FI index futures long-short ratio. They continue to remain net long, but close to around 57% of their positions on the long side. But let's pull up the stock futures. On that, well, that's the common factor between them. They continue to remain net long out there. Moving to the levels that you should be tracking then. Well, yesterday's low becomes important. That's yesterday's low. The earlier low as well that we saw earlier in the week, that's going to be important. That's the budget day low. And in fact, the 20 DMA becomes important. So from a bullish perspective, you don't want to break these two levels. You want to buy the dips and in fact, continue to trade above the 20 DMA. But the Nifty Bank, that will take center stage because that's the one that's been dragging. And it's been making lower lows. For the last 6 sessions, on a day-to-day basis, the Nifty Bank has been making lower lows. And the point I made yesterday, the 50,500 level is extremely important. Yesterday, we went rather close to there. But from there, we did see a bit of a bounce. So that's going to be the important mark to track, the 50 DMA out there. Stocks we're looking forward to for the August series itself, HDFC Bank. It's corrected, post almost hitting that 1800 odd mark. Now we'll have that weight update that will come on August 13th. So we'll keep an eye out on HDFC Bank. Hopefully that can turn the fortunes of the Nifty Bank. And from the cash market, since it's going to be a stock-specific market, I'm looking at Jamna Auto. Yesterday, the stock was strong. It's on the verge of going to a 52-week high, which is at around 145 rupees or thereabouts. So that's going to be important that it hit in April. And yesterday, there was massive delivery-based buying on this one. So that's why I'm keeping an eye out on Jamna Auto. Should be on your radar.
Okay, thanks a lot for that. Well, let's kickstart the show now with some views. First up on the money markets, Lakshmanan V of Federal Bank says that the dollar index pulled back from a 4-month low following the ECB policy decision. Complemented by positive GDP data, he says both euro and pound trimmed gains as the dollar strengthened and the Japanese yen experienced volatility, giving up earlier gains. He says the market awaits the US PCE data and the policy decisions from the Federal Reserve and the Bank of Japan. He adds the rupee depreciated to its lowest level, influenced by a decline in local equities. And for the coming sessions, he expects the dollar INR to trade in a range of 83.50 to 83.90.
Well, on bonds, Lakshmanan V says government bond yields fell slightly after the budget on revision of the fiscal deficit target to 4.9% for FY 24-25 and a promise of further reduction to a 4.5% for FY 25-26. He says US Treasury yields hover in a narrow range on lack of any significant cues ahead of the US PCE data. He expects the 10-year benchmark bond yield to trade in a range of between 6.93 to 7.02% in the next few sessions.
Okay, let's slip into a quick break. On the other side, John Stolfus of Oppenheimer Asset Management will be joining in to put focus on the global cues. Do stay tuned in.
Welcome back. John Stolfus is Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to have you with us here. Thanks for your time. I was talking about the unwinding of some consensus trades. Tech is underperforming. Small caps are outperforming. Should we here in India take any indication from that in terms of rub-off effect? We've had a big rally in small caps, so we've had an opposite kind of a issue. And second is this big move in yen from the 165 to 155. Is that leading to sort of risk reduction across asset classes at all? Go on.
Well, I guess the first I'd have to say related to the unwinding of the trade in New York, most of that has to do with the fact that the GDP number came in today and gives more than likely the Fed will not be cutting in July, as some people were beginning to think at the July Fed meeting. We were of the opinion that the Fed may not even cut in September, which would cause more unwinding. This time around in New York, it would be, or in the US, it would likely be unwinding the trade that near term has boosted the small caps. Much like at the beginning of the year, we saw an unwinding of the trade. A lot of the market had expectations that the Fed was going to begin cutting more than the Fed had even intimated at the end of last year, when they said about 2 or 3 times they would be cutting. The market thought it would be something 4, 5, 6, even 7 times, and that didn't happen, and there was unwinding. So we're not surprised at all at the unwinding that we saw leading up here, because with related the volatility that we saw in New York, and then the market rebuilding throughout the day, where originally the large caps seemed to recover somewhat, but with small caps still outperforming. But by the end of the day, the large caps were either flat with a negative bias, really, or what you were looking at was a slight positive, I think, in terms of the Dow. But when we look at this, I have to say, this is a period of uncertainty, because what you have is a lot of highly leveraged players are really looking for the Federal Reserve to cut interest rates, and the Fed has still not decided that it is the time to do it. If we think, though, there's a chance for more disappointment in September, and we don't think it's a particular concern, because ultimately we expect the Fed will cut rates in November and December, probably 25 basis points at a time, to serve as a down payment for both Main Street and Wall Street stateside. Now, related to the Japanese yen, a lot of that would appear to be that's been around intervention by the Bank of Japan and then supported by traders. It will be interesting to see what happens as we go forward if that relative strength in the yen will persist. It would bring back the yen carry trade, but based on the numbers that we see at 155, I think we've still got a ways to go to really say that the yen is showing significant strength. In terms of India's market at small caps and large caps, I really have no comment at this time. My view on India is much more intermediate to longer term, quite frankly.
Okay, well, on that note, we'll thank you. Thanks a lot for joining in and giving us your time. Your view on India in the medium to longer term is positive, so we'll take it from there. So let's slip into a quick commercial break. On the other side of the break, we have our entire research team joining in to help us with the list of top 10 stocks. Stay with us. Welcome back to Bazaar Morning Call. This morning, actually, the GIFT Nifty is suggesting a positive start, but let's see which way it goes. About 30 points higher. For now, the market has been very resilient, but lots of stocks in focus, so let's get straight to that. Mankind Pharma is the big deal, and the big, all the action is around Mankind Pharma. Rachna joins in now to give us the latest on that. Rachna, go ahead.
Thank you so much. Well, it is a CNBC-TV18 News break confirmed. We had first reported on May 14 that Mankind is considering an acquisition of Bharat Serum and Vaccines from Advent International, and now the company announcement has come in. In fact, the announcement came in late last evening. The enterprise value of this deal is pegged at about a little over 13,000 crore rupees. There are two things that we're watching out for. One is a question that how is Mankind Pharma looking to fund this deal? Now, sources have also told CNBC-TV18 that it's going to be a split of equity and debt. When we had first reported the story in mid-May, shortly after that, the company had come up with an announcement that they're looking to raise equity of 7,500 crore rupees. And now our sources tell us that it's the same equity raise that they had conducted in May will now be put towards this deal, and the remaining will come from a debt. The other important thing to watch out for is how will they integrate Bharat Serum and Vaccine, given that it's a very big deal and they have gone all in with this. So these are the two things that we and the street will of course be watching out for.
All right, Rachna, thanks very much and congratulations. That's a sort of big story, big news break getting confirmed. But let's get into the nitty-gritties, right? I mean, how is the street going to take this? Ekta is here with us. Ekta, tell us.
Thanks for that. Well, I expect Mankind to probably react positively to this deal. Now, firstly, the EV has come in lower than what the reported valuation was. Separately, BSV has FY24 margins on an adjusted basis, which are at 28%. Compare this to Mankind at around 25% for FY24, so it's not margin dilutive. Revenue up 21% CAGR in the past 3 years for BSV. Mankind is going to expand its footprint into the women's health category as well as critical care, and that's going to aid their chronic portfolio, which they have been very focused on. It's around 36% of their domestic sales. BSV also has an R&D arm, so they have a patented women's fertility drug as well. So that gives a sense in terms of the R&D prowess of the company. It has R&D capabilities with around 60 scientists. It will help Mankind expand the export market, which is just about 8% of their total sales at this point point in time. Net, Mankind is also known to be really the underdog which came up in the domestic pharmaceutical space to become one of the largest companies. FY24, 10,000 crores is what they did in terms of total revenue. So the street will probably believe that they will manage to, successfully do this. Fundraising would be something that we'll need to watch out for Mankind.
Okay, all right, Ekta, thanks a lot for that. Well, let's hop across to Rima, who's here to tell us about Tech Mahindra's numbers. Morning, Rima.
Hi, good morning. So Tech Mahindra has reported numbers which are slightly better than muted expectations. So the company's top line growth has come in at 0.7%. EBIT margins have expanded by 110 basis points to 8.5%. Both revenues and margins are slightly ahead of street expectations. Strong pickup in deal wins too on a quarter-on-quarter basis. The deal wins have crossed that $500 million mark, higher than the average of the last 4 quarters.
Okay, thanks a lot, Rima, for that. Well, back to Ekta now to track Sun Pharma. Ekta, over to you.
Well, yes, important news which has actually come in for Sun Pharma overnight, where they have received approval for their alopecia drug, which is basically a new drug application which they had. Now they're branding this drug as Leqselvi. It is used, it is going to be used.
Ekta, I think we can't hear you very well, so we'll just come back to you in a bit. We'll go across to Sonal. She's tracking DLF this morning. Sonal, what's the news there?
Well, DLF reported numbers and the bookings were strong this time, came in at 6,404 crore rupees, which are up 214%, led by the new project Privana, where they clocked in 5,600 crore of new sales in Q1 itself. Company has a launch pipeline of 9 million square feet going forward. They're bullish both on the residential and the rental markets. The operating cash flows have also improved to 1,849 crore rupees, which is up 133% on a YY basis. And now their net cash versus net debt earlier. So balance sheet and the operational update looking very strong.
All right. Thanks very much for that. Well, let's move on to IT companies as well. Mphasis reported numbers, and there was Cyient which is reported as well. How do they look? Rima is here with details. Rima, morning.
Hi, disappointing for Mphasis. So Mphasis revenue growth has declined by 0.1% on a quarter-on-quarter basis, lower than street expectation. EBIT margins are flat at 15% at the lower end of the company's guided band of 14.6 to 16%. That said, the deal wins have been very, very robust this quarter. So that's the silver lining. But I'm going to go with red for Mphasis because of a muted top line growth. Cyient is the one where there is a big disappointment. It's a shocker. Revenues are down 10% and the company has now lowered its guidance. They classify the business into main segments, but one of the key segments, it's called digital engineering technology. It contributes a bulk of their revenues. Earlier, the guidance was for high single digits. Now the company is guiding for flat revenues for this business. So very, very disappointing for Cyient. Back to you.
Okay, thanks a lot for that. Well, United Brewery is also on our radar. Let's find out how the numbers look. Sudarshan, over to you.
Morning, Sonia. So UBL has reported numbers for Q1. If you look at overall numbers have come in largely in line or slightly beat, led by the premium segment. Talking about the revenue, it has come in at rupees 2,475 crore against our poll of 2,615 crore. EBITDA has come in more than rupees 285 crore and margin has come in at 11.5% versus poll of 10.3%, which means almost 100 bips higher than our poll. Volume growth, overall volume growth has come in at 5% versus poll of 8 to 9%, and it's dragged by popular segment, while premium volume growth was healthy at 44%. On the outlook front, company says it's driving the share of premium in its portfolio. It continues to remain a focus for the company and will drive margin accretion through revenue management and cost initiatives. So considering all these factors, I'm going with green for UBL.
All right, we take that analysis, Sudarshan, for now. Later on, you can grab a pint, maybe later this evening. But let's go back to Ekta. She was telling us about Sun Pharma. Ekta?
Well, yes, they've received US FDA nod for a new drug application for their drug, which was under development for alopecia. Now, this drug is going to be branded as Leqselvi in the US markets. The drug is used for severe alopecia in adults, and hence it's expected to be a significant drug for Sun Pharma. Remember that the US FDA had already approved the filing acceptance of the new drug application in October of 2023. So the street was probably expecting such a development to take place, but it's considered to be a definite positive for Sun Pharma because the potential is $200 million of sales at least in the next 3 to 4 years from this particular drug, and will add on to their specialty portfolio.
Okay, well, thanks a lot for that. Well, Abhishek is also with us to tell us why you should be watching the banks this morning. Abhishek, good morning.
Well, the regulator is coming hard on banks and looks like the draft norms can impact the liquidity coverage ratio of banks. So to begin with, RBI's draft norms does suggest that banks shall assign additional risk weight for internet and mobile based deposits, that is IMB based deposits. So 5%, 10%, 15% are the variants that they have given. 10% for stable deposit, 15% for less stable deposit. If you take a look, they have also said that level 1 HQLA, that is high quality liquid assets, shall be valued at an amount not greater than current market value. So level 1 HQLA to be adjusted for applicable haircuts in line with the margin requirement that is there for liquidity adjustment facility, that is LAF, as well as MSF, that is marginal standing facility. So deposits, if they are pledged as a collateral to a bank facility or loan, will now be included in the LCR or liquidity coverage ratio computation. Now that was not the case earlier. So IFL Securities does say that they expect an LCR hit of about 11 to 18% on various lenders. Back to you.
Okay, all right. That's banks, and I think a lot of discussion will be around this latest RBI move, and we'll see. It's a negative as far as bank stocks are concerned. MGL is going to be in focus as well. Sonal is here to tell us why. Sonal, hi.
Good morning, Prashant. Well, Mahanagar Gas reported good set of numbers. Like IGL, there was a margin expansion versus an expectation of a decline this time. So going with green on this one. Revenues up 1.5%, EBITDA up 6%. Margins have improved by 100 basis points versus an expectation of a 100 basis point decline. Profits are also up on a quarter-on-quarter basis. So EBITDA per unit has come in at 11.9 rupees versus an expectation of 10.5. It is also a volume-led beat mildly. So volumes at 3.86 MMSCMD versus an estimate of 3.8 MMSCMD. So going with green on this stock today.
Got it. All right. Thanks for that, Sonal. Well, let's hop across to Yash, who's here to tell us about GoDigit. Morning, Yash.
Good morning, Nigel. So, of course, first set of numbers announced by the company post its listing, and it's a good debut which the company has made with its Q1 FY25 numbers. Your net earned premium has grown at a strong pace of 24%. Underwriting losses have gone up, but very marginally, just about 2%. But as against that, a strong operating profit has come about with a growth of 2.3 times in that particular number. That's largely because of the jump in the total income which the company's made. Combined ratio, this will be an important point, has gone down by 80 basis points. This is coming at about 105.40 versus 106.20. Now, combined ratio is a good fact to look at when it comes to the numbers for GoDigit Insurance. Coming down of these numbers would be positive today.
Okay, thanks for that. Well, Vivek is with us to talk about why you should be watching SOBA this morning. Vivek, over to you.
Well, good morning. A large block deal is expected in SOBA today. We accessed the term sheet, and as per the term sheet, Annamudi Real Estates, which is actually owned by the Godrej Group, is looking to sell 5% equity today. Remember, they hold close to 9.9% stake in the company. The total deal size is estimated at close to 830 crore, and the deal price will be at a discount of 6% to yesterday's close of 1,862 rupees is where the floor price is. There is a 90-day lockup on further sale of shares. Kotak Securities is the sole banker to the block deal. So expect some red on the stock to start off with.
All right, thanks very much, Vivek, for that. So lots and lots of news flow, isn't it? So that's what a busy morning looks like, a busy day looks like. We'll take a quick commercial break here. Up next, we'll have Siddharth Khemka of Motilal Oswal Financial Services, who will talk to us about the most important stocks which should be moving today based on earnings and otherwise. Stay tuned, that's coming up.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Well, let's get some fundamental analysis going. We have Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, who joins in. Hi, Sid. Good morning and good to see you, Ben. Well, let's address a couple of big numbers that came overnight. You had quite a few IT names, and the big one out there was Tech Mahindra. What's your view? Some marginal improvement in margins and a small beat in revenue growth.
Yeah, very good morning, Nigel. Glad to be on the show early morning. So if you'll see, there have been divergent numbers from some of the IT companies. But thankfully, Tech Mahindra, the new management, the efforts are now paving and they are the quarter numbers are, we believe that is a step in the right direction. Especially the recovery in EBIT margins, despite a seasonally weak Q1, was encouraging, and we believe that while a lot of things, the guidance has also been on the positive side. The only thing that concerns us is that the company's major segment, which is the communication, that continues to remain under pressure and would take time to see some recovery. Nonetheless, last few quarters, they have come out with very good numbers, encouraging numbers, better than expectations. So we would expect, yes, some recovery in the near term, but we would have to be on the sidelines given that the new management has a lot of things on their hands. The communication segment needs to show some recovery, and valuations still at 23, 24 times leaves a little room for upside. So while we maintain a neutral rating, I think in the near term, with the back of two back-to-back strong quarters, the stock should do well.
Okay, we have ICICI Bank's numbers tomorrow, Siddharth. Any thoughts here? I mean, what is the expectation and how are you positioned on this stock?
Yeah, good morning, Sonia. So I think if you look at the overall banking numbers have not been that strong. And within that, I think only ICICI is the one which could come out with strong numbers in the current environment. We saw what Axis did and the kind of punishment the market gave. Today, the announcement from RBI in terms of the liquidity ratios, that is also kind of negative for the banking sector, given that it will impact the liquidity ratios for some of the large retail deposit companies, especially the PSU banks, as well as some of the small mid-size companies. So given that, I think ICICI would continue to do well. We are expecting it to kind of show strong numbers, both in terms of NIMs as well as in terms of overall profitability. So expecting a good deposits growth, good loan book growth, and the asset quality should also be pretty strong.
Okay, Siddharth, just stay on. We'll come back to you in a bit. For now, the management on the show is Ashok Leyland. It's the first management on the show. It reported a muted set of numbers, but gave a very strong guidance of mid-teen margin growth in the medium term. Also, the company is eyeing new electric vehicle launches in the next 2 months. To discuss all this and more, we have Shenu Agarwal, the Managing Director and Chief Executive Officer at Ashok Leyland. Mr. Agarwal, good morning. You saw single-digit growth on the top line for Leyland this quarter. Could you explain what went down, and do you see this muted growth continue, not just for Leyland, but for the industry itself?
Yeah, see, at the beginning of the year, there was a widespread anxiety that CV industry may go down by as much as 15% in H1. And I think this view was developing because of the impact of elections. And at that time, there was some amount of uncertainty with the monsoons as well. But now Q1 MHCV industry has grown by 10%. Yeah, so I think that has set a very, very positive momentum for the whole year. Even in the beginning of the year, research agencies were of the view that market MHCV industry would be down by 4 to 7%. But now, since we have grown by 10% as a MHCV industry, I think the outlook is changing. Now, also because of all the economic measures that have been announced in the budget, I think the positivity is building more actually. So we are very optimistic about Q2 and for the rest of the year as well.
Okay, you're very optimistic about Q2 and for the rest of the year. Got that. You said MHCV growth for the industry is 10%, but your own revenue growth is only 5%, which means you're perhaps seeing some weakness in other segments like LCVs, etc. And is it fair to assume that you will see a single-digit top-line growth for the full year FY25?
Yeah, definitely. I think, MHCV industry has grown by 10% and we have grown more or less in line. Our growth in MHCV has been 8%. So we have still retained our market share close to roughly 31%. While LCV industry has degrown slightly or is kind of flattish, but our volumes have grown. So we have gained market share in LCV by about 1.1%. I think the only reason that we have not shown appropriate or on the top line is only because on the power solutions business, our volumes have degrown by about 19 or 20%, and so is the revenue. And the reason for that was that Q1 of last year, we had a lot of pre-buy, right? So that is because, that is why the Q1 power solutions business has not performed that well as compared to Q1 of last year. But I think going forward, even power solutions business will do well. Our defense business is doing really, really well. We are doing very well on aftermarket business also. So yes, as I said, we are very optimistic about the industry, and of course, at Ashok Leyland, we will try to beat the industry growth.
All right, Mr. Agarwal, let's focus on margins then. There was a big fall on a quarter-to-quarter basis to around 10.6%. But do you expect more pressure on margins? I ask this because raw material costs as well have gone up a little bit.
Not at all. We are very, very clear that on margin front, we will continue to do better. We are also very clear that we are not going to discount our products to win market share. We are also clear that market share has to come on the back of the superiority of the product and also our ability to give a delightful experience to our customers. Yeah, so on profitability, we are not going to compromise at all. Like you said, Q1 of last year, we were at 10.0% EBITDA, and now we have already improved it to 10.6%. I think going forward, we will continue to focus on profitability. Even on the commodity side, we don't think that there is anything to really worry. I think the commodity prices are quite stable. We are actually getting benefited from the commodity price. But also at the same time, our focus on cost reduction internally is going through a lot of rigor. Even last couple of years, we have had record cost savings. Even this year, we have a lot of visibility to save cost. So I think altogether, the industry is performing well. Ashok Leyland will gain market share. The commodity prices are helping. Our cost saving is showing a lot of promise. So I think given all this, our margins should improve going forward.
Okay, so when you say that your margin should improve going forward, right, what kind of margin growth can we expect? You're sitting at an exit margin of 10.6% in Q1. For the rest of the year, what are we looking at?
Yeah, see, what I can tell you is that, quarter on quarter, when compared to last year, we will continue to improve our margins. It is very hard to give you a particular number, but I can again say that we are very, very focused on margins. To us, market share will not come from sacrificing margins. Market share will only come from the superiority of the product and superiority of our customer service. So market is doing well. The commodity pricing are good. Cost saving is at its peak. So we don't think we should look back now on the margin front.
Okay, what kind of growth do you see for the LCV segment? Is there a double-digit growth expectation? I'm asking because a lot of these segments like e-commerce, white goods have started to see, quite a bit of traction. So on LCVs, what are you looking at?
So on LCV side also, we are quite optimistic, although Q1 has remained quite flattish on the LCV side, but we think the momentum will come after this budget announcement. I think a lot of positive sentiment is developing around LCV. I think there has been very, very good forecast around the e-commerce growth and white goods growth, right? So all that should really help LCV. I am very confident personally that we should see much better growth rates in LCV going forward. Now, as far as Ashok Leyland is concerned, we are preparing to launch 6 new products in the current fiscal year, 2 of which we have already launched in Q1. The balance 4 we will launch in the subsequent quarters. So on the LCV front, also we are quite hopeful that we should be able to beat the growth levels of the industry.
Okay, we'll let you go at that, Mr. Agarwal. Thanks a lot for joining in here on CNBC-TV18. Well, time to slip into a short break. Up next, we'll connect with Rikin Shah, the Vice President at IIFL Securities, as the RBI has released draft circular on Basel III framework on the liquidity standards. Stay with us.
Okay, welcome back. 15 minutes to go for the pre-open session. The big story from the Reserve Bank of India, of course, is RBI's draft norms on liquidity coverage ratio. Now, these are draft rules, but they say that banks will have to assign additional risk weight for internet and mobile banking-based deposits. So, what does this mean for banks, and is this negative to what degree? We have Rikin Shah, Vice President at IIFL Securities, joining in now. Rikin, good morning. Good to have you with us here. Thanks for your time. What do you make of it? I mean, first of all, what percentage of accounts would be sort of internet enabled in that sense, digital enabled? And what does it do to sort of LCR for the banking sector, if you've sort of done any numbers?
Sure. Good morning, Prashant, and thanks for having me. Before I get into the numbers and the impact, the genesis of RBI doing this, last year we saw SVB in the US seeing a big deposit run. $40 billion plus deposits were moved out in a single day. And given the increasing nature of digital transactions, the deposit runs for the banks during the stress periods can be much faster. And hence, to improve the liquidity profile, RBI has tweaked the norms. Now, talking about the specific question which you asked, they have increased the runoff factor for the retail deposits and the deposits kept by small business customers. The runoff rate has been increased by 5 percentage points. Now, when we discuss with the banks, a large proportion of these deposits are held digitally, in the sense that a customer either has access to mobile banking, net banking, or even UPI facility. So any customer who has access to any of these three things will see the runoff factor going up. And in our discussions, we have assumed, after speaking with the banks, we have assumed that around 80% of the total retail deposits would be impacted, given that they are digitally enabled. Whereas for PSU banks, it can be slightly lower. And the retail deposits typically constitute anywhere from 45 to 55% of the total deposits for the bank.
So, sorry, can you explain for our viewers, when you say runoff factor would be higher, what do you mean by that?
So basically, in the LCR calculation, there are certain cash and the government securities that you hold, which is included in the numerator. They are considered very liquid, which you can liquidate in the periods of stress and quickly meet the obligations. In the denominator, they look at the stressed cash outflows in the next 30 days. And hence, for instance, if there are certain deposits held by us, a certain haircut is applied to that. So let's say a 5% runoff factor is applied. And if you have 100 rupees of total deposits, retail deposits are 50%. So on 50 rupees of those deposits, 5% of runoff factor was applied earlier. And hence in your denominator, this 50 into 5%, your 2.5 goes into the denominator as the cash outflow. Now this runoff factor has moved up from 5 to 10%, and hence the denominator has increased, which is why your LCR goes down, and the regulatory minimum is around 100%. So that answers the first part of your question as to what proportion of this retail deposits are digitally enabled or have digital facilities. The second part of it is how do we quantify the impact for the banks? We have done some sensitivity analysis. First point worth highlighting here is that for the PSU banks, they have been consuming excess liquidity and they've brought down LCR very dramatically by 15 to 20 percentage point in last 2 years. They are still higher than your private banks. Currently, private banks are around 120%, PSU banks are around 130, 35%. That is how things stand today. Among the top 15 banks in India, IndusInd, IDFC First Bank, and Federal Bank have relatively lower LCR compared to the peers, of course, much above the regulatory minimum of 100%. Now, basis this changes in the draft guidelines, we discussed one aspect of it. There are a couple of other technical aspects which I'm not getting into. We estimate that the LCR, pro forma LCR, can go down by anywhere from 10 to 20 percentage point and drive margin compression and earnings impact for the bank. So it's an incremental negative for the banking sector.
How much earnings impact, Rikin? I mean, roughly, in what range?
So the LCR hit is, as I quantified, 10 to 20 percentage point. So many banks will go closer to 105, 110%. Banks like Federal Bank may see their LCR fall below the regulatory minimum of 100%. So that's on the LCR front. On the PNL impact, given that now to shore up this LCR, you'll deploy more money in your securities which are lower yielding rather than loans, and CD ratio goes down. So there is a negative spread. So the NIM impact of mid-single digit and earnings impact of mid-single digit. While for PSU banks, the LCR is still going to be comfortable, but the margin impact and the sensitivity is relatively higher in terms of the EPS impact on their P&L.
10 seconds. Most impacted stocks today?
Federal Bank can see a bigger hit because the starting point of LCR is relatively lower. Even IDFC First Bank has relatively lower LCR. So among the top 15 banks, just basis the sensitivity analysis, these are the stocks who could see more impact. But it's generally the entire banking sector which gets negatively impacted, and we'll have to wait what the bank representations to the RBI are and consequent final guidelines. These are still draft guidelines at the moment.
Yeah, no, absolutely. We don't know if they'll give any offset, and but we, at this stage, right? But these are draft regulations, but markets will treat this, as you said, more negative, and of course, more negative for some as compared to others. You mentioned two, Federal Bank and IDFC First. Rikin, a quick conversation this morning, but we'll sort of pick up on this in some detail with you later. Thank you for joining us. We'll slip into a break. Prakash Gaba and Sudarshan Sukhani will join, and we get a little technical trading ideas, that is, on the other side. Stay tuned.
Welcome back. Well, as promised, let's get straight to our technical experts. Prakash Gaba and Sudarshan Sukhani are joining in this morning. Good morning, gentlemen, and thanks a lot for joining in. Well, Sudarshan, you go first. Tell us, what's your view on the index? Last couple of days, we've been resilient. The dips are getting bought into, but it's a fresh new series. So how do you approach trade?
Yeah. Good morning. See, my view on the index is that we are probably at the top of some kind of a rally. Now, how this will pan about is something I cannot say, but I'm assuming that the markets will either consolidate or eventually correct. This is also seasonally a dull period. The end of August and the full month of September is a time when markets usually correct all over the world. We are at elevated levels, so the correction is even more imminent. So my view for the short term is don't actually take this trade on the long side. Do nothing. For the intermediate term, we'll get better prices for investors.
Okay, Prakash Gaba is also with us. Prakash, hi, good morning. This is a market that's consolidating but not falling, which is a good thing for bulls, right? At this point in time, would you advise buying this, consolidation, or do you think that it's better to just wait a bit? And what are the levels to watch?
Yeah. Good morning to Sonia. Well, basically, what you said is absolutely correct. I agree with you. It's not following signs of strength. The problem is in Bank Nifty. There's a divergence between Nifty and Bank Nifty. The Bank Nifty needs to support Nifty for Nifty to go up. If it doesn't support, Nifty also has a limited upside. So I think we need to resolve this issue. Some kind of time-wise correction is needed, and perhaps we should get it. And after a week or so, perhaps we should see an up move. But yes, we are in stronger footing as far as Nifty is concerned.
Okay, we'll take a quick break on that note. Actually, I do want to ask you folks about individual stocks, but we'll come back with the pre-opening rates and also with the individual stocks. And we also have Manoj Vishwanathan of Home First Finance to put focus on their Q1 earnings. So stay tuned. Okay, good time to get some ideas going from our technical experts, right? So let's get straight to them. Prakash, let me start with you. There is no dearth of good quality names in this market. Of course, in a time of a correction, that's what you look for. So technically, and even for the slightly positional trader, what are your views now on individual stocks?
I've decided to go for a defensive bet and avoided banks intentionally. The stock that I like is Havells India. That certainly is looking good. It's trading at around 1831 zones. Stop below 1795 or 1800 should be just fine. The targets in the near term I have is 1900 zones. So Havells India is looking good. The second stock that I like is showing some resilience is Ashok Leyland. Has formed a good base, trading at around 232. Have a stop below 230, just 2 rupees. Possibly we'll see an up move here. And that up move could take it to around 240 zones. So Ashok Leyland is looking good. And finally, I like Ipca Labs, given some kind of a breakout, demonstrated strength, traded at around 1257, stop below 1246, just 11 rupees. The near-term target is around 1300 zones on Ipca Lab.
Okay, all right.
Thanks for that, Prakash. Sudarshan, what about you?
Well, Biocon is a buying opportunity. It had a good day yesterday. Buy with a stop under 345. Mahanagar Gas is the second buy I have. Stop under 1680. My only intraday short is Naveen Fluorine, where you can have an intraday short with a stop above 3600. And my final buy is Zydus Life with a stop under 1160.
Okay, thanks a lot for that, gentlemen. We'll come back to you all for your 9:10 call. But let's go back to Sid Kemka, who's waiting by. Sid, I wanted to ask you about the big deal that was announced on Mankind Pharma. How do you read this? We are at CNBC-TV18 with the first to report about that. And bang on, that was announced late last night. Tell us how you read it.
Yeah, Nigel, I think so. Congratulations to you and the team on the news outcome. So definitely, we are looking at it at a very positive development. Mankind Pharma has agreed to buy Bharat Serum Vaccines for an enterprise value of about 13,600 crores, which kindly roughly comes to at an EV/EBITDA of about 22 to 23 times on FY25 basis. What this acquisition does is it expands Mankind's niche portfolio. It provides specialty R&D tech platform and also in-house complex manufacturing capabilities. And finally, also provides it with strong institutional reach. So given that it is the acquisition is giving access to the high entry barrier business, a healthy mix of domestic and international segments, as well as a good potential for sustainable EBITDA growth, we believe that this deal is definitely positive for Mankind. While we wait for the pro forma numbers and other things, we have a very positive view on Mankind and a buy rating target price of 2650.
Okay, no, absolutely. And Mankind is a very strong, sort of fast-growing domestic player. But I mean, I think even for them, it's a very large acquisition. That's the only thing I think which markets will watch out for. Stock starting about what in the pre-open 5% higher, so 2250 is where the stock is starting at this point in time. Now, just a few other names, right, where I think there's been pressure sort of lately. Sid, if you want to sort of come in on your Mazgaon Dock, Garden Reach, and a few of these sort of shipbuilding companies, there's been news reports that there is a new shipbuilding policy which is going to be announced soon. What are your ratings here?
So, Prashant, unfortunately, we don't cover this space as of now. While we are positive on the overall defense opportunities for some of these shipbuilding companies, they have ran up too fast, too soon for to give any comfort to the analysts to start covering them. So, unfortunately, don't have a view, but I believe that the government is definitely supportive to the entire space, and the policy will only add to the positive view for the entire defense, domestic defense manufacturing space.
All right. Sid, we'll leave it there. Thank you very much for your time. Great speaking with you. And it's a pleasure. Well, let's bring in our first management on the program. Home First Finance is who we are talking to. They reported a steady set of business growth. Disbursals and assets under management improved. Let's decode this. We have Manoj Vishwanathan, Managing Director and Chief Executive Officer at Home First now joining in. Manoj, great to have you with us here as always after every quarter. Thanks for your time. So we'll talk about the implications of the margin of the budget, etc. But let's start with the numbers, right? NIMs were down about 6 basis points on a quarter-on-quarter basis. Was that something that you were expecting? I think you were indicating towards some pressure. Is this it? And what can we expect from here? Manoj, you'll have to unmute yourself, please.
Yeah, the rates have been going up, gradually. So we had expected this, and last quarter we had mentioned that there could be further increase in interest rates and borrowing cost. So that has played out as expected. So there has been a slight reduction. But broadly, we are in the same 5.3% NIM range, which we have maintained. And our overall income has been maintained at about 7.5. That's what we had mentioned last time as well.
Okay. Well, I want to know a little bit about growth as well, right? What kind of loan growth are you looking at? What is the sustainable loan growth? Because I was going through one report which suggested that you could double your AUM by FY27. Is that, a legitimate estimate? And what kind of loan growth would you look at, say, AUM growth by the end of FY25 and 26?
Yes, you are right. So we have always indicated about a 30% annual growth rate. Taking that calculation for the next 3 years is how we have arrived at that doubling of the portfolio in the next 3 years. So we are at about 10,000 crores now, 10,478. So we had mentioned that at a 30% growth rate for the next 3 years, we should be able to hit that 20,000 mark by FY27.
Okay, all right. Hi, Manoj. Good morning. Always good to see you in. And your NIMs, just to confirm, you'll hold it at around 5.5%, right?
Yeah, we are at 5.3. So 5.3 in that range, we should be able to hold it now.
Okay, so around 5.3 to 5.5. I asked you 5.5 because the last time we were drifting towards that number. So should we hold it as a range, 5.3 to 5.5?
Yes, see, there will be, because as we are scaling up and, the leverage keeps on increasing, there is going to be, reduction in NIMs, that is natural. There will be a gradual reduction in NIMs every quarter. But we have to keep the eye on the ROE numbers because the leverage is also increasing correspondingly. So as you can see, we have, compared to last quarter's ROE, which was 16.1, we have moved it up to 16.3 this quarter.
Got it. 16.3 and NIMs we should work with is around 5.3%. Got it. Well, tell us a little bit about the gross NPAs. That increase on a sequential basis. What's the outlook on the asset quality from here on?
So gross NPAs have been the same. So 1.7 is what we have reported, which was the same as last quarter. There has been no change there. So overall, the asset quality has been stable.
Manoj, referring to it on an absolute basis, it's at around 155. That compares to around 139. In percentage terms, it's the same. So just wanted your sense on that.
Yeah, percentage terms, it's the same. So because the portfolio growth is kind of constant every quarter. So we are growing at an annualized rate of around 30%. So given that there is the gross NPA has kind of remained at about 1.6, 1.7% if you see over the last several quarters. So we don't see any issues as far as asset quality is concerned. And our other metrics, the early delinquency metrics like 1 day past due, 30 day past due, etc., also holding up very well.
On OPEX, would you want to give us a guidance? How much OPEX would be up in 25 over 24?
OPEX, again, we have maintained that we'll be in that 2.7 to 3% range. So this quarter we came at around 2.7. So broadly in the 2.7 to 3% range is where we will be for OPEX as a percentage of overall assets.
Okay. Just one point. Is there a... I mean, you've said 1 or 2 sort of private equity transactions, right, a year. Is something lined up in the next 2 quarters?
Nothing planned as of now. But as we had mentioned, the private equity funds, will contemplate probably 1 transaction a year. So that's really what it is.
But nothing on the anvil as far as you know it right now.
That's right.
Okay, but 1 is pending, right?
1 transaction a year is what they have indicated for liquidating their stake.
Absolutely. All right, we'll leave it there, Manoj. Great to speak with you. Thank you very much for joining us and running us through that detail. Very fast growth. 30% is essentially what their growth rate has been. Stocks up about 2%, 1,050 coming through there. Well, let's talk about Ramco, which reported numbers yesterday as well. Nigel, take us through the numbers.
Well, that's right. Ramco Cements reported their numbers, and actually the street has been very, very cautious on Ramco Cement. So let's see what's the initial rate that we're getting up on the screen. The numbers are expected to be more or less subdued, and some on the street, they're worried about the competitive intensity. Let's run you through the numbers. On the top line, there was a bit of a miss, and that was because the volumes were a little bit lower. Marginally lower, we were working with a number of around 4.5 million tons odd. It missed by around 100,000 tons odd. So that was the reason that the top line was a miss. But what was encouraging is the EBITDA number actually came in better. The absolute number beat estimates. Even in percentage terms, it came much higher. Why is that? Because they're focused on the cost side.
And the power and fuel costs came down by close to 25% on a per ton basis. That's because of their focus on green energy, and they've been taking various measures out there, combined with the fall in fuel prices on a year-on-year basis. What was encouraging about these numbers is two factors. One is, earlier in 2026, they said that they'll be moving to around 26 million tons. Now they're talking about going to 30 million tons. And now they've also mentioned in their press release that it will be done at minimum capex. So that's what the street will like. They'll have to quantify what is that minimum capex, but that's important. The net debt, remember, has been moving up, and that's moved up to nearly around 5,000 crores. And the street is getting cautious about this number because that's getting to an elevated level. But encouraging to see that they're given a time span that in the next 12 months, they're looking at selling some non-core assets and raise closer under 1,000 crores. So they've given the timeline as well as the quantum. That's encouraging, and that's something that the street will like. But otherwise, brokerages are cautious on the stock. Whether you look at Citi, they have a sell rating out there. You have CLSA, they have gone ahead and they've downgraded the stock, and they've also cut the target price. And Jefferies as well maintains the underperform. The thesis why the brokerages are cautious on them is you have a new entrant, that's the Adani Group, that's made its presence felt in South India. So, volumes could go up there, keep pricing under pressure, and competitive intensity on the whole could continue. That's why, in fact, for starters as well, the stock is down by close to 1.5%. But what was encouraging is they're focused now on reducing debt and they're increasing capacity at minimum capex. So we'll keep an eye on that one.
Okay, well, we're also going to be talking about Cyient this morning. Reema's here to tell us why. Reema, over to you.
Thanks so much for that. So, Cyient's Q1 numbers were not a miss. They were actually a shocker. Very, very disappointing set of numbers. The consolidated revenues for the company have fallen by 10% on a quarter-on-quarter basis. Now, the company classifies its revenues into two brackets, but the main one is digital engineering technology. They call it DET, and that's the metric that the street generally tracks. So their DET revenues fell by 5% on a quarter-on-quarter basis. All the verticals that they operate in, whether it's connectivity, transportation, sustainability, new energy, all the verticals saw a decline on a sequential basis. And after such a dismal start, the company has lowered its full year guidance. Now, the guidance is for the DET business, which is more than 80% of their overall revenues. Earlier, they were anticipating high single-digit revenues. Now they're saying flattish revenue. This is on account of a delay in project ramp-up in telecom. There's continued weakness in rail. So, very weak numbers, a big cut in the company's guidance. And it doesn't end there. Brokerages believe that even achieving this guidance looks to be difficult. In fact, Nuvama put out a note saying that from Q2 to Q3, the company will need to deliver 3% quarter-on-quarter revenue growth every quarter. And that, according to them, is a tall task. So Kotak also agrees. They're saying the lowered revenue guidance is also aggressive. They cut EPS estimates by 14 to 18%. But they still are bullish on the stock because of medium-term opportunity and reasonable valuations. Nuvama titles their note as a shocking quarter, valuations to save the day. But the cheap valuations limit potential downside. They retain their hold rating on the stock, lower the target price, but no taking away from the fact that this is the weakest, earnings from the tech sector this quarter. Back to you.
Oh, I mean, that's, as you said, disappointing, really. 5% lower, by the way, in the stock in the pre-open. Let's look at Emphasis as well. That's the other one that Reema had highlighted earlier. And there also, it's a poor set. Stock's down about 45, 50 bucks, 2,800 on Emphasis right now. Well, let's talk about MGL as well, which should be in focus. So back to Sonal for that. Sonal.
Well, yes, MGL was a good set. Margins were something that the street would like, better than expected. And it is an increase in margins on a quarter-on-quarter basis versus an expected decline. They've come in at 26.3% versus an estimate of 24.1%. Overall, revenues have grown by 1.5%, EBITDA is up 6%, margins have come in at 26.3%, which is an increase of 100 basis points, and profits are up 7.4% as well. It's just not the margins, even volumes are slightly higher. They've come in at 3.86 MMSCMD, which is a double-digit growth for the second consecutive quarter on a YOY basis at 13%. And they've come in higher than estimates of 3.8 MMSCMD, where CNG volumes were up 12% on a YOY basis, and industrial and commercial volumes were up 24% on a YOY basis. EBITDA per SCM has come off from the record highs, but was still up 4% on a sequential basis at 11.9 rupees per SCM and better than expectations of 10.5 rupees per SCM. On the back of these good numbers, Jefferies has gone ahead and increased the target price on the stock to 1990 rupees per share. They say rising APM shortfall going forward, it puts a lid on the margins, but the company has now taken a price hike, so that should take care of that. And it's surprising the margin expansion at a time when gas prices were higher. So that's the update on Mahanagar Gas.
Okay, all right. Just opening up in a minute or so. Actually a couple of seconds now. 7 seconds to go for market opening. 120 points lower on the sensex, higher on the sensex, and 30 points higher on the nifty. So that's a start for you, at least as far as indices are concerned. Yesterday was flat, but of course it was off the lows big time, and it was outperformance. So it's a quieter start this morning. 24,400 around is where the nifty is starting at. Nifty bank straight off the bat, and I think we should look at banks because that LCR norms, draft norms from RBI will take a bite out of some of these banking names. It's starting 0.4 down. The index, that is. Mid-cap index is up 0.6%, and I think the small-cap index also should be higher. So broader markets outperforming. Market breadth is about 3:1 in favor of advances straight out of the gates. Some of the big movers in terms of stocks are at the bottom of the screen on the Nifty, but lots to track. Sonia.
To track. So let's begin with, actually the mid-cap index is flying off the shelf right now, 460 points higher. So really the broader market is opening up. In terms of individual stocks, the Hindalco, Kotak Bank, Sun Pharma, Coal India are your top gainers on the index right now. By the way, Mankind Pharma is also in focus, right? So 3% higher last time I checked on Mankind Pharma. And a couple of other stocks. Remember, Tata Motors had that upgrade yesterday. So that one continues to see some more traction on the upside this morning, up about 1% odd. So keep an eye out on that. A couple of other stocks that we're looking at this morning. Soba, there is a large trade that has happened in Soba. About 5% equity has changed hands. So that stock is down almost about 2.5%. And a couple of other names on the Nifty that we're looking at this morning. ICICI Bank comes out with numbers tomorrow. IndusInd Bank also awaiting numbers. So those stocks ahead of the earnings are a tad bit under pressure. HDFC Bank is also under pressure. So the Bank Nifty is the one that's really dragging right now, down almost about 260 points. So that is the space to look at. Apart from that, Tech Mahindra is also your big loser right now. 4% knockdown on Tech Mahindra on the back of muted earnings. So not looking good there at all. Couple of other stocks in the broader markets. Now the Bank Nifty, by the way, is down almost 300 points. In the broader markets, Federal Bank is under a lot of pressure. Ujjivan Small Finance Bank, IDFC First Bank, IDBI Bank, any bank you pick is seeing a cut of anywhere between 1 to 2%. On the upside, Ashok Leyland is up about 3.5%. The management commentary was quite positive in the interview that we just had a while back. They're very optimistic about the MHCV growth and going forward as well. They saw an 8% growth in MHCV segment this time in this quarter, and going forward as well, things will pick up. Apart from that, Indus Towers is up 3.5%. SAIL, Vedanta also looking pretty good. But otherwise, it's the Bank Nifty that's dragging this morning.
Well, that's right, Sonia. Indus Towers, that one has run away because they're going to be considering a buyback. The street was waiting for an announcement with regard to a dividend. They have gone for the buyback route. So that explains why that stock, in fact, is high. They'll be having a board meet with regard to that. Texmaco Rail, that stock is flying away, one of the top volume movers on the upside. They've acquired Jindal Rail Infra for around 615 crores, beg your pardon. So that stock, in fact, is up close to around 2.5%, and it opened with a gain of more than 5%. BL Kashyap, they have bagged a new order worth around 160 crores. So that one as well has opened up well in the green. SJVN, one of the big movers this morning. They've got an LOI for a project worth around 13,000 crores from the Mizoram government. So that's why that's up more than 10% as we speak. Vedanta, they'll be considering a dividend meeting later today. Vedanta Resources, well, that one got an upgrade as well late in trade yesterday. So that's building onto yesterday's gains. Federal Bank, the stock is lower because as the IFL analyst, Ricken told us that it'll get the hardest hit by the RBI draft proposals. That explains why that's pulled back close to around 5%. Loris, yesterday we did see a bit of a pullback in late trade because of the commentary. But the stock starts off, a little bit lower. It was down close to around 3%. It's pulled back a little bit. At the bottom of the screen, you have Sterling and Wilson. They are bagged an order for around 330 crores. So that one as well is up and about. So good start, 50 points. August series starts off in the green.
And so absolutely, and it's a good one, right? So a few other names where there is a lot of action and sort of excitement. Telecom, right? You mentioned Indus Tower, Nigel, but Idea is up about 3% as well. Almost 15.6 or so on Idea. And of course, Indus has been the favorite. So those who want to pick Bharat, I mean, this or that, I mean, Indus is the common favorite. Well, VST Industries had a big sell-off day before yesterday, I think, 7-8%. It's coming up with a 2.5% pop right now. Ashok Leyland is up about 4%. I think Sonia mentioned this earlier. But look at Emphasis. Emphasis is now 3% higher. I'm not sure if the start was lower, but it's seen a big recovery from where it began. Raymond is starting about 3.5% higher. You've got Motilal Oswal Financial Services. I think it's the highest ever quarterly numbers. Earnings for Motilal, 2.5% up on Motilal. There is Ixigo, which is the travel portal, 2.5% up, 177. Venus Pipes is up 2.5%. Go Digit, that reported numbers, and Yash had highlighted the earnings. That's the big mover today, 7.5% on Go Digit in terms of upside earnings reactions, which are coming through. It's, of course, a fairly recent listing as well, which is coming through. On the downside, you've got MMTC. I think it's had a couple of 20% days. It's down 3%, very large volumes. Tech Mahindra is down 4%. That reported numbers yesterday, post-market hours. Sobha is down 4%. And Mankind is down 2%. So that's interesting. I think in the pre-open that was indicating a bit of a sort of, a higher start. But it's a lower kind of start, at least for now. It's a large acquisition, and they've kind of sort of gone all in on one deal with this very large acquisition. So we'll see. Cyient, of course, Rima has been highlighting this. So very poor numbers. Stocks down almost a full 9% now. And STC India, RBL Bank, Chennai Petro, SBI Card, Route Mobile, BSC. These are all nothing large, but between 1 and 1.5% down. At this stage.
Also, just wanted to mention Tata Power. UBS has initiated a buy on Tata Power. They have a target price of 510 on that stock, and they talk about how the energy transition theme, right, is one theme that's really working well for them. And there's very strong EBITDA growth that they're looking at because of their foray into renewables, power generation, of course, but solar equipment manufacturing, large-scale solar EPC projects, etc., and how valuations also look pretty reasonable. So that's one stock in focus.
I just want to pull up Ramco Cement. The intraday chart should come out. The stock started off in the red with a cut of around 2.5% approximately. There are challenges over there because there's more competition. Pricing is under pressure. The stock has now recovered 4% from the low point of the day. Why is that? The street has two positives. One is their focus on reducing debt. They're talking about reducing debt by 1,000 crores in 12 months. And the second factor is they're saying that in the next 2 years, there'll be a 30 million ton capacity. Earlier, they were talking at around 26 million ton capacity. So it explains why the stock has recovered close to 4% from the low point of the day.
Absolutely. And it's a big mover in terms of the sort of action so far. Andrew Holland is with us, Chief Executive Officer at Avendus Alternate Strategies. Andrew, great to have you with us here. Thanks for your time. Appreciate it. Your run through of the earnings that we've got so far, Andrew. I think, and I looked at the numbers of NSE 200 companies till the day before yesterday. About out of the NSE 200 group, about 65 had reported numbers. I will put out detailed data later. I mean, there are many more disappointments as compared to surprises. I mean, one pocket which clearly comes out as a surprise is life insurance. Apart from that, not very much. Your thoughts, Andrew?
No, I completely agree. The results season so far has been disappointing, and what we're seeing is analyst downgrades. And even if they're not downgrading, they're downgrading the share price target, which is the same thing to me. This, after the budget, I was just thinking, what's the catalyst for the market? I mean, great macro, nothing wrong with that, but nothing there for the banking sector in terms of helping them in their, gaining deposits or building up their deposit base. Therefore, NIMs remained under pressure, and with this RBI, paper today, it's just pouring a little bit more cold water on the banking sector, which is a huge weightage in the Nifty. So, I think it's going to be quite rotational in terms of the sectors that people are going to pick out, and also for stocks. So, I don't think earnings is going to be the catalyst, Prashant, at all. So, I think if anything, at best, the market drifts lower and consolidates. I don't see a big fall, but these kind of valuations, you need to have earnings growth ahead of expectations, not below expectations.
Andrew, hi, good morning. There is a lot of disenchantment after the budget, right, on the back of higher taxes, as was expected. I mean, if, you know, the long-term capital gains tax was something that people were fearing for a very long time, and finally it came through. So there is, of course, that kind of disappointment. But do you think the impact is limited on the stock markets now, or do you expect to continue to see a lingering impact? Because taxes have been hiked across the board, not just in equities, but even in asset classes like real estate.
So I think there's two parts. The increase in long-term capital gains tax, I think, would be, you know, normally absorbed by the market. So I don't think that's the worry. I think in terms of short-term capital gains tax, it could hit some of those favoured retail stocks which they've been trading in over the past few years. And of course, we still have to wait for the SEBI rule. So let's see what any regulations that come around that as well. But you know, I think the concern for me is not the recent increases in capital gains tax, but the direction. I think that's the key, is the direction upwards and onwards going forward as well. And I think the message to me is, yes, it is. So I think that's something the market's going to have to work out going forward, because taxes is something that the government is clearly wanting to increase. And if I read all the kind of statements by the finance minister, the stock market's one of them.
So if, you know, if one has to take a call now, right, on the markets for the rest of the year, what's the best way to approach it? Do you sit on cash waiting for that dip? Do you continue to deploy into some of these large cap, you know, names? Do you stay away from mid caps? What's the best way to approach the market now?
So there's two parts to that. It's a great question in that I don't advise sitting on cash. I just think that, you know, if our view is that the market should rise in line with earnings growth, and we're thinking about 15% this year, then up until, you know, the budget, the market was up already since April 10%. So there's very little gain in the Nifty, that is. So I think the themes that play underneath the Nifty, and we talked about these before, are the ones where you should deploy you know, your cash into the market. So I think it's going to be sector themes and individual company themes which will make you the most money this year. I don't think it's the Nifty.
Well, Andrew, good morning and good to see you. And last time around, you know, England was doing quite well in the Euro Cup. I thought the next time we speak, you'll be champions. Did quite well, came very close, but unfortunately couldn't deliver the final blowout there. Maybe next time. Let's talk about markets. Since you're saying themes will work, what's the top theme you're bullish on from here on? That top sector that you believe will make money from here?
Yeah, well, first of all, Nigel, thanks for reminding me about the loss.
No, you played well to the finals, but I think outplayed by Spain at the end. Let's get to the markets.
Yes. So, you know, I think there's two themes that I really kind of like going forward is the premiumization. I talked about this before in beverages, and I think if you're going to play the kind of FMCG, you know, kind of sector, then I think those companies, you know, in the beverage sector, both alcohol and non-alcohol will continue to do well. And you're starting to see that in their results as well. So that's one. And I think hospitality in terms of hotels, I think is going to continue to pick up. And I think these are kind of early runway kind of stories which are going to play out over the next 2 to 3 years. So that's where I'd be looking at the two big themes. The one point I should have mentioned previously was that in terms of the market and you know, our expectations, the one thing that we should look at is when we think the Federal Reserve is going to reduce interest rates. If it's September, then we could think about the RBI, you know, later in the year, reducing rates as well. So the banking sector will come back at some point. I just don't think there's a catalyst right this second.
Okay, there's no catalyst right this second. Got that. Any other themes that stand out for you for the rest of the year, and anything that you would be cautious on right now?
So I'd be obviously cautious on the banks in the very short term, because I think there's too many headwinds for them, and NIM's you know, compression is still there. And I would, in the very short term, again, just be a little bit more wary on metals. I don't think China's stimulus is pushing it enough. So I just think those are the two sectors I'd be more wary of in the very short term. So probably, you know, if you came out of the budget, the trade was long Nifty, short banks, and that's probably worked well for you.
Okay, all right, Andrew, thanks a lot for joining in. Wishing you a good day ahead and looking forward to chatting up with you in the coming weeks. Well, let's focus on the first company then that we have post-market opening, Laurus Labs. Well, they reported a weak set of numbers. The company reported its lowest margins all the way since Q1 FY24. Revenue is flat because of the decline in the CDMO and formulation business. But to discuss what went on in the past quarter and more importantly, how will things shape up from here on, we have with us Mr. Satya Narayan Chava, the founder and CEO of Laurus Labs. Hi, Mr. Chava. Good morning and thanks a lot for joining in. Well, it's the same story. Earnings miss yet again, but you're promising better times ahead. Let's get more clarity on that front. Let's solely focus on the margins first up. Now, margins on a sequential basis as well a little bit low, and it missed most estimates on the street. But you're saying that margins will improve. And the last time we chatted, you said at some point of time it gets to 20% in FY25. Which quarter do you see margins get to FY25? And on a quarter-to-quarter basis, will margins start improving from here on?
Good morning. There are two ways we should look at this margins. You are looking at gross margins. We did exceedingly well. If you look at the last 10 quarters, we never went below 50% gross margins. That shows the quality of the business what we are running. And you are looking at EBITDA margins. Because we invested significantly in capacity expansion, we invested significantly in R&D. We have done a lot of new initiatives in biotechnology, cell and gene therapy. All those are investment for the future. Those initiatives dragged our EBITDA margins because we never capitalized any of those expenses. So if you look at gross margins, we have done very well. If you've done EBITDA margins, that is only transient because we are investing ahead of the curve for our future growth. As we mentioned earlier in a couple of calls, the kind of pipeline we have for the CDMO business is very, very encouraging. And we are very confident to do well in that segment. Main reason is this transition, what company is embarked on, moving from a highly generic API focused to a highly focused, very differentiated CDMO is taking a little longer than what we thought. Otherwise, we are very comfortable the way we are investing. We are investing for the future.
Okay, all right. But Mr. Chava, let's focus on the CDMO business because that's the one that will drive margins, drive profitability as well going ahead. And in the past quarter, it declined in double digits. When do you see this business get back to its growing ways? And you explained to us on gross margin, but what about EBITDA margin? Which quarter does it go to 20%? So just two factors, growth in CDMO and EBITDA margins. When does it go to 20%?
I think by end of this year, we expect the EBITDA margins will go to closer to 20% for the entire year. So what it means, our second half is going to be good for us. It is because of the orders what we have. We are not saying with any anticipation. We know what orders we have and what products we are going to deliver. So that will take our EBITDA margins significantly higher than what we have shown in this Q1.
Mr. Chava, so FY25 margins will be 20%, right? That's which is what you said last time also.
Yeah, we will say, yeah. We have
will be not because you said by end we'll reach 20. It means sometimes
no. Full year EBITDA will be
20. You've not given. I mean, last time also you didn't give any sort of numbers on sales. Would you like to give us some indication? What should we expect for the full year? I mean, qualitative commentary is great, but if you could also quantify it somewhat.
I think we stayed away from giving quantitative guidances. But see, for us, there are two things. One is don't invest, reduce R&D spend, retire debt. That is easier path. But the toughest path for us is to invest for the future, make the company very stronger in the current geopolitical scenarios. You don't get opportunities twice. See, if we stay away from the investment, company will lose a great opportunity. So we took a tough path and started investing in the technologies which customers are looking at, invested in continuous flow chemistry, invested in biocatalysis, invested in large scale capacity. So all these are investments are going to yield good results. We need to have a little bit more patience, and we are investing with a lot of conviction, and we are investing with customer based on what customer is looking at.
Mr. Chava, good morning. On the balance sheet side, I think the street is a bit concerned about how your net debt to EBITDA has worsened to about quarter on quarter to 3.3 times. Just want to understand, as of Q4, your debt was about 2,500 crores. What is the plan going forward? Do you look to bring it down? And what level are you comfortable with in terms of debt to EBITDA?
I think by end of this financial year, we expect it will come closer to 2.5. So we don't. Okay. I think it is very transient. See, as our EBITDA numbers are lower because of deleverage, that debt by EBITDA looks a little over 3. But it will come down by end of this year. We're very comfortable to get it down.
Okay, so you said by end of this financial year, your debt to EBITDA will come down to 2.5 times. And on the absolute debt number from 2,500 crores, what are you looking to bring it down to?
It will remain at the similar level. That number will go down because we will get more EBITDA. It's not because we are bringing it down the net number by end of this year.
Okay. All right. Mr. Chava, just to reconfirm, that margin number of 20% calls that in the second half of the year, you may have to do 22%, to get an average of around 20% since the first quarter has been a little bit soft. That's correct, right? You're confident about 20% margin for FY25. Just confirming, sir, because the street wants that number.
No, we'll get to the 20% EBITDA number for the whole year.
Lovely. Thanks for clarifying on that. Besides that, you were telling us as well the CDMO business, that will start turning around sometime in this year itself. Since you're so optimistic about margins, it's still degrowing. So I ask you that.
I think a significant ramp up will happen in Q4, but some improvement will be there in Q3 also.
Okay, all right. And are you seeing any incremental orders coming in from China Plus One?
I think because of the Biosecure Act, a lot of inquiries coming, but it will take its own time to convert those inquiries into commercial orders. Maybe it will take several quarters.
Okay. Can you tell me a little bit more about the growth in the ARV formulations business and what kind of guidance can you give us, both for the ARV formulations and the API business for FY25 and 26?
I think ARV business has reached a plateau, as we mentioned in our conference call also. We expect both API and ARVs put together will be, give or take, 2,500 crores. So we don't expect that segment to grow beyond that number.
Okay, got that. So that is for FY25, you said, is it?
I think FY24 we did closer to that. FY25 will be like that. And we don't expect growth in that segment.
Oh, you don't expect growth at all across that segment?
Yeah, in the ARV segment, yes.
Okay. All right. You're not giving us a guidance on revenue, Mr. Chava, for FY25. But will FY25 be closer to FY23 in terms of revenues?
No, we will grow. So we grow beyond that. Yeah.
Double digits?
I don't want to give
grow.
Yeah.
You're saying revenues in FY25?
Yeah.
Please go ahead, sir.
No, but we are not giving any quantitative guidance as I mentioned earlier. See, if you look at our asset turnover ratios, the highest we did was 1.4. If you take the 5-year average, we did asset turnover 1.1. But currently it's 0.8. So as we start delivering projects, I think all numbers will come in line. So we are not concerned about the current situation.
So the investments that you have lined up will take you to more than $1 billion, say in the next 2 years or so, because you're focused on investments right now, and then it gives you a good runaway. So say in the next 2 fiscals, you'll get to around $1 billion with the kind of investments that you've made. Does it have a revenue potential of $1 billion at least?
No, if you look at our highest asset turnover ratio we did was 1.4, and our assets are can give definitely that number.
So around 10,000 crores is what you can do, going by that asset
I'm
turn?
not commenting on the number, but our infrastructure is capable of delivering much higher number than what we are doing.
So around 10,000 crores, going by asset turnover, 1.4 times your asset. It will be around 9.5 to 10,000 crores at peak potential revenue?
We see, if we stop investing, we stop growing, as we look at. So we also continue to invest further. So we're not going to stop the investments into infrastructure this year, next year. We continue to invest.
Got it.
Okay, well, we will let you go on that note. Thank you so much for joining us and speaking to CNBC-TV18. While Canara Bank is the other stock that we're going to talk about, reported a weak set of Q1 numbers. Net interest income came in at a 7-quarter low. Even gross and net NPA ratio is the lowest in 9 years. To discuss this and more, we have, of course, to discuss the impact from the RBI's draft norms, we have Satyanarayan Raju, who is the MD and CEO of Canara Bank. Mr. Raju, thanks a lot for joining in. I just want to ask you first, before asking you about your own business, what is the impact from the RBI's draft norms on your liquidity coverage ratio?
Madam, our liquidity is for existing. We are very much comfortable. We are at the range of 135 to 140. That's the existing liquidity what we are maintaining it. What the guidelines yesterday our regulator has issued, we have assessed roughly in the morning, and it is impacting 10 to 11 basis points. I don't think that will have a problem for the Canara Bank, because even after doing all these things also we will be more than 120-125%. So I don't think it impacts our credit growth or CD ratio or anything.
So this doesn't impact your CD ratio. Got that. What is the outlook as far as loan growth is concerned, and where are you seeing for loan growth both for FY25 and FY26? What is a realistic assumption, and where are you seeing maximum traction coming from?
So last time also I shared with you, all of you, though we are given the 10% credit growth in our guidance, we may grow 11 to 12%. That's what actually we have communicated, and we stand by that. And in the first quarter, you just look at that, we are almost grown at 10%, even after shedding a 22,000 crores corporate loans which are at lower yielding. That's the exercise we are doing for the last 2 quarters. Previous March also we did around 20,000 crores, and the June also we completed that 22,000 crores. With this, that exercise is completed, and we don't have any corporate exposure below the 7.5%. So we will taken care of the yield on the corporate. Now corporate yield has improved to 8.29%. This is very well placed in that. So now that shows that the even traction in the corporate also is good enough for us. But our earlier guidance is we want to keep our RAM at 58% and corporate at 42%. That's why always we are focusing more on the RAM sector. And you see that from the year on year, last year June it was RAM was 55%. This year it is now June 57%. We are almost reaching to what we have kept the target. And now the next 3 quarters, I can see that the corporate credit, we are ensured shedding of 22,000 crores, means almost we have dispersed 40,000 crores in the first quarter itself. If you have to disperse 40,000 crores, the sanction should be more than 50,000 crores. That's the traction we have even in the corporate. And the RAM sector, we have taken its retail as our driving force, because there you will get a higher returns. And to strengthen that retail, what we have done is, because our strength is our gold loan, we have introduced a new retail loan for the metropolitan city branches at a higher rate of interest. That has helped in the first quarter, that in 1 quarter we have grown retail at 12.39%. Year on year, if you see that the growth retail is now first time in the history of the Canara Bank, we grown at 23%. Of course, slightly it is impacting our agriculture growth, because we have stopped lending in the metropolitan city in the gold loans against for the agriculture purpose. And in the corporate, the traction what we are seeing is, earlier also I shared that infrastructure anyhow it is there. Then that the solar energy, more proposals are coming. But because we have taken enough exposures, we are little selective in that. And data center creation is one of the areas where we are getting it very high. But the NBFC, what we have shed most of these corporate loans for central public sector undertakings and all is all fallen in the NBFC. So our NBFC exposure has come down drastically. That's from 144,800 to 118,500. That's almost 26,000, 27,000 crores reduction in the outstanding. So we have a cushion to lend to the even NBFC to some extent. So these are all the cases, but we are selective and we don't want to compromise on the returns. In the MSME, whatever the budget has given to us in the clue for that the MSME lending should be in the internal rating, not on the based on the balance sheet or even the risk rating, it is in the external rating. Actually, this particular issue we are already implemented in our Canara Bank for last 1.5 years. We are working for the last 3 years in this to segregate the lending to the MSME from the regular way of risk rating. That's why this first quarter you can see that our MSME also has grown at 2.42%. We are expecting that there also traction will be there and we can do better.
Okay, all right. Hi, sir. Good morning. Given that there is so to call it a scramble for deposits and the competitive intensity as well is getting a little bit more difficult. How do you see this panning out? And are the yields, enough to offset that? Keeping both those two together, what is the outlook on NIMs from here on?
So first let me speak about the deposits. In the last year also, if we verify that, our bank has grown in the double digit, whereas none of the peer banks could show that double digit growth in the deposit. And this first quarter also, we have seen year on year the growth is more than 11%. The reason behind is this liquidity crunch or the market problem. This we could assess initially in the first month itself in the last financial year. So we have taken this deposit mobilization as a critical point for us. If you see our retail term deposits, first time in the last 5 years, we have grown more than 10% for that. Even in the first quarter also, we have grown 2.63 for that. The savings regarding the CASA, definitely there is a tough fight is there on that. But savings cost, we are absolute numbers, actually we have grown actually in the savings individuals because of our innovative products, so unique products and the services, innovative services what we offered. Savings bank has grown in absolute numbers. In individuals, it's almost near to the 20,000 crores. But in savings bank, again, there are institutional deposits which are draining out because of the central government policy of SNA system, single nodal agency and all. That's going out of the system. That is being compensated with growth in the savings bank individuals. That's why in absolute numbers, the growth is reflecting is only 12,000 crores in the savings. CASA current account, though we are growing steadily in that, maybe a little slow. But the last March, we got a windfall from one central government where we are the bankers for them, some 15,000 crores. That 15,000 crores has converted into bulk deposit in the first week of April. That even that's a 15,000 if you leave it. In the first quarter on quarter, you see that the difference is only 11,000. That means cumulative we have grown in the first quarter also CASA 4,000 crores. So we have focused on that. We will continue to focus on that. Even this year, though we are given the guidance at 9%, we grow at 10%. Regarding the NIMs, what you are asked, this NIM also what we have expected, that's we have given the guidance. That is the reason in the last quarter when we are announcing the results itself, we are given for this financial year guidance at 2.9, but we are hopeful and confident that we can reach around 2.95. That's what we communicated earlier. And we stand by that, and that's the proved. We have assessed correctly what is our balance sheet position, what is the market conditions. Because the first quarter, the cost of deposit still continuing at very high. Because to meet the credit growth in the last 2 quarters of previous financial years, banks have raised more deposits at high cost. That will impact for this first or second quarters. That's why first or second quarters, the NIMs will be comparatively little lower.
All right, we'll leave it there, sir. Thank you very much. It's great listening to your perspective and detailed explanation as far as Canara Bank and, of course, the industry right now. We'll take a quick commercial break here. We'll be joined by the management of Mphasis. Stocks up 5%, and we'll have the management join us in just a bit. What is the market focusing on? Is it the deal wins? Because it certainly is not on some of the other aspects like the weak constant currency growth, etc. Nitin Rakesh and Manish Dugar will be with us in just a bit. Okay, welcome back. We have Emphasis in focus. Stocks up 5%. Constant currency growth was down 0.1% Q on Q. Margins have come in closer to 15%. I mean, that's closer to the sort of guidance range as well. Let's talk about this more. We have Nitin Rakesh and Manish Dugar joining in to take some questions on the business going forward. Gentlemen, good morning. Great to have you guys here on CNBC. Prashant this side. Nitin, I think you've spoken with investors, analysts in the morning, and what you've told them, the market's kind of lapped up. So why don't you tell us is it deal wins which are looking super strong, especially on the BFS side, etc. Just run us through what you're seeing out there.
No, Prashant, thank you for having us, and thank you for the kind words. I think we basically talked about what's going on in the business, both from a industry perspective, but more importantly, I think coming off of a difficult 23 in the industry, especially in the banking business, which is a big portion of our revenue. This is the second successive quarter of sequential growth in our BFS business, which I think is a great sign for the longer-term growth prospects as we go through the remainder of FY25 as well. Secondly, we've seen some really good build-up, not just in TCV. TCV was obviously up sharply QOQ, but we still have a great demand, great visibility into the demand through the pipeline, which is actually up 17% just sequential. So I think very broad-based pipeline across top clients, non-top 10 clients, BFS, non-BFS, across geographies and across verticals. So I think it's the broad basing of the visibility through the pipeline, good delivery on TCV wins, second quarter of sequential direct business growth, and of course the recovery in BFS. And I think those were some of the headwinds we faced last year. So this is really the fog lifting off of that uncertainty that's giving us a little bit of boost today.
Just to complete that point, last time after the earnings when you spoke, you said that smaller, shorter duration deals are the ones which have picked up and they convert quickly. Has that changed? Is it more? Are some of the larger deals also coming in that pipeline?
Yes. Yeah, actually, not just in the pipeline, Prashant. In TCV that we announced this quarter of $319 million, we have 3 large deals. One is over $100 million, which is a good sign for the fact that clients are now feeling a lot more confident in undertaking what we are calling savings-led transformation deals. I think the other thing to call out in the pipeline is, we spent the last 18 months as an industry with our customers figuring out the potential of Gen AI, and now we are starting to see scale up of Gen AI-led deals. So a third of our pipeline is actually AI-led, and that gives us great hope that we'll not only be able to create a sustainable, longer-term business model around this new pivot, but more importantly, there are ways to create value for customers that give us a lot more stickiness.
Okay. Nitin, hi, good morning. This is actually great to hear because I think I haven't heard you this bullish in a while. Not bullish, but I guess just, relieved that recovery is coming through, especially in spaces like BFSI, etc. So I mean, just before we head to Manish, right, I just wanted you to complete that argument. BFS saw a 1.1% quarter-on-quarter growth. Now, a lot of peers are talking about green shoots, not just you, but green shoots across the board. Infosys said that that's happening in North America. TCS said that North America did better than Europe, etc. In terms of growth, what are we looking at? And geography-wise for BFS, can you just give us some more clarity on where the recovery is coming through?
So we obviously, given that BFS is roughly half our business and BFSI is almost 60% of our business, we were probably one of the first ones to get impacted as the discretionary slowdown happened in BFSI in 2022. So at this point, I think we're very pleased that we were the first ones to show recovery at the end of Q3 last year. We called the bottom in that segment. We saw 2+% sequential growth in BFS in Q4 and another 1+% this quarter. We also closed a large $100+ million deal in BFS in Q1. I think this is still without any major uptick in the mortgage business. So that's an additional, event. That's a pure cyclical event. It's not when it'll, if it'll turn, it's really when it'll turn. So I think some of that optimism over the next 12, 18 months will also come through the pickup in that line. But I think it's a good sign. We are seeing banks typically being forward-leaning on adoption of new tech. As I mentioned, they spent the last 12, 18 months setting up their pipelines, figuring out the tool chain, and now very open to ideas that not only give them savings, but more importantly, give them transformation. So the narrative in a nutshell, the narrative is shifting from cost takeout to savings-led transformation, and that's great news for players like us.
Okay, well, Nitin, you've set the tone then. You're sounding rather optimistic about the future from here on. Let's try to get a couple of numbers. Manish, let's come across to you. You all mentioned last time around that FY25 will be better than FY24. The FY24 was a bit of a degrowth year. How much better can it be? Mid-single digit, close high single digit, if you could quantify that. And also your margin band is that 14.5% to around 16%. Towards the end of the year, do you see heading towards the higher end of the band?
Absolutely. We started the year, or rather we ended the last year with a sequential growth, and we continued the sequential growth in the second quarter as well, which is Q1 of this year. And like Nitin mentioned, that gives us a tailwind for the year going forward. The pipeline and the TCV wins gives us confidence on what we expect in the coming quarters. And our guidance is that we would be able to deliver above industry average growth rate. So clearly, both in terms of percentage terms as well as in terms of relative performance versus the peer group, this should be a better year than last year. From a profitability perspective, philosophy has been to invest for growth while maintaining margin in a narrow band. We had guided to a range of 14.6% to 16% margin for the year, and we delivered 14.9 last quarter, and we delivered a 15 this quarter. Last quarter, the margin had a one-time upsides, and this quarter, despite those one-time upsides mostly not being there, we were able to actually expand the margin over the last quarter. Going forward, we continue to have tailwinds to the margin, and as the revenue scale-up happens, operating leverage plus utilization and the improvement in exchange realizations will all contribute to more tailwinds, which can help us invest while maintaining a northward bias to the margins. So from an overall perspective, we feel very confident that we should be able to certainly be within the range and maintain, if not expand the margin from the 15%.
Okay. Nitin, the other thing is that the company has been focusing a lot on diversifying revenue. I agree that, you were talking about such a big chunk coming in from BFSI, right? But you've been looking to diversify that and diversify your contribution from your top 10 clients as well. Where are we on that front and what's the progress?
I'll give you some statistics. So top 10 accounts grew 1.2% sequentially, but the next 20 grew 3.5% sequentially. That's definitely a metric that we are very happy with. New clients have grown at about 22% year over year, which as a segment is now starting to get meaningful, and we've put a lot of focus on the hunting piece. We also broke out the BFS versus non-BFS pipeline. I think the non-BFS pipeline is actually up 30% sequentially. So diversification away from just top 10 to the next 20 or next 30, diversification into other verticals outside of BFS, diversification into areas like Canada and Europe. So our Europe business was up 10.5% YOY this quarter, which I think is the best growth we've seen in the last few quarters there as well. So I think multiple levers of diversification at play. It's just, as in a business portfolio, that's always a slow and steady climb. It's not a 1 or 2 quarter event, but the direction of travel is absolutely where we want it to be.
You said 1/3 of the pipeline is Gen AI, Nitin. How are margins in this work?
A little bit too early to call for that, Prashant. I think the first port of call was, is this really hype or there is some real substance in enabling efficiency and solving problems that were far too complex. So we actually announced the launch of 2 platforms today. One of them is a Gen AI-enabled modernization relearn platform that actually disentangles complexity from legacy applications, by applying Gen AI to extract logic. So I think right now we are focused more on the value that we can create. Pricing and margins, this isn't really a rate card play or a managed capacity play at this point. This will definitely become a value-based pricing play, but a little bit too early to call for that. Obviously, we would like operating leverage. We would like some non-linearity to come into the business, but very hard to say, how we'll be able to manage that kind of change with both customers and, of course, our own field. So early days, but again, direction of travel is in the right direction.
US mortgage segment is what percentage of your business?
It's about 6% of revenue. It grew sequentially, marginally this quarter. We had seen it stabilize towards the end of last calendar year, and in Q4 and Q4 it grew very minimally. Q1 it grew a little bit more, about 2% or so. It's about 6% of revenue, but as I said, it's very hard to call the macro. So we are not baking any major, event-driven triggers there. As I mentioned, it's not if it will happen, but when the cycle will turn. And as that cycle turns and we see some pent-up demand there, I think that should be a good tailwind as well.
Nitin, besides the company, for the industry, what kind of growth are you looking at for the coming fiscal?
It's hard to call. I mean, if you look at the weighted average forecast, I think it seems like in the low to mid single digits at this point in time. I guess as we go through the year and as the client, I mean, it's not like the discretionary environment has changed dramatically in the last, 1 quarter. It's just that the client's openness and at least there is a consensus on a soft landing, visibility in the U.S. Again, every day there are new data points, including the GDP data from last night. So I think there is definitely more openness to having conversations and potentially, originating ideas based on transformation, and how quickly that ramps up will determine where the industry heads into. But I also think there's going to be a redistribution of market share in terms of, adoption of new tech, and some segments of the industry will definitely see some headwinds, especially as Gen AI adoption picks up scale.
All right, and you'll outgrow the industry by around 1.2, 1.3 times? Or more?
Hard, we're at this point just saying we will grow faster than industry. We haven't quantified that, and as we get more visibility, we'll do that.
Good, great conversation as always, Manish as well as Nitin. Thanks a lot for joining in. You're sounding optimistic about the future. The street is buying into that as well. Explains why the stock now at the high point of the day as we speak. For the time being, we'll slip into a short break. Come back, we'll continue to focus on markets and on stocks. Don't go anywhere.